Hey, yeah, good evening, everybody, and very warm welcome to attend our very first Wealth and Wellness series seminar. And annuity is our first topic, and it's very much retirement related. I want to introduce myself. My name is Lou, and I'm a licensed financial professional and specialize actually well-rounded family financial planning. And I'm also a certified college funding specialist. And together, I'm with my business partner, Pam. And Pam, I'm going to let you introduce yourself.
Okay, hi everyone. My name is Pam Chow. I'm also a licensed financial professional. I have over 20 years of experience in employee benefits and retirement planning. It's a great pleasure to be here today and to share some of our experience and knowledge regarding annuity. So we're going to chat later. Okay.
Thank you. Thank you very much. So today's topic is about annuity, and we're going to talk about why we want to think about annuity as part of the retirement strategy. And Pam is going to cover a lot of the content on annuity, the product itself. It's in-depth analysis on what is annuity and what is some of the key features, what's the benefit, and what's the pros and cons. And then we're also going to touch how the cash accumulation works and how the lifetime income works. So we're going to do some illustrations towards the end of it. And the whole presentation is going to take about 45 minutes. And we really want to keep you, we want to keep it on time. We don't want to go exceed 1 hour, so we will finish it by 9 p.m. regardless. And if you have any question, and we encourage you to write down your question at the chat box, and I will take a look at it later, and then we can see how many we can go through. You do not need to take a notes, and it's a lot of content. You do not need to take notes because we're going to post this to YouTube. So you can like us on YouTube and follow us. So let's get started. What do we know about retirement? I love this topic because I do a lot of the college financial planning for parents. And a lot of time after the college financial planning, I often ask them, have you planned your retirement? Do you know anything about retirement? So I want to emphasize the 3 things about retirement in the current environment. And the first thing is, it's our personal responsibility. Very, very important. It's our personal responsibility. It's nobody's responsibility but yours. Why? Because the availability of traditional retirement income sources have much reduced, and we don't have a lot of resources. If you look at the retirement source before, and you can see we have Social Security, we have pension, we have personal savings. So it's probably 1/3 from Social Security, 1/3 from pension, and 1/3 from personal savings. But now, and Social Security is a lot less than you expected. And a pension, most of the companies stop providing pension as a retirement tool. And more and more lie on your own shoulder. And it's your personal savings. And I do want to point out, I want you to remember a number. It's 2034. So Social Security cash reserve actually will be completely depleted by the year 2034. Now, I'm very sensitive to year 2034 because that's the year I plan to retire. So now the government is telling me there might not be enough Social Security. And actually, they don't think there will be any Social Security left by year 2034. There was a lot of talk about how to make up this crisis, right? To manage this crisis. So a lot of saying about they're going to push the retirement age from 67 to maybe even further to 70. And the second option is they will increase your tax. But regardless, and the retirement is going to be your personal responsibility. And it's very important to remember that. And the second thing is probably a lot of people don't know, and it's lasting a lot longer than it used to be. Why? Because healthcare advancement and a healthier lifestyle, we are all now living much longer than past generations. Don't let that picture disrupt you. And retirement could potentially last 25 to 30 years. And this is a scary number. Imagine you retire at age 65 and you still have 25 to 30 years to live, or even longer if you're part of a couple. So this is a probability of a 65-year-old surviving to the select age. And I'm looking at, I'm a married, so I'm couple. So nearly 90% of the chance I'm gonna live 85 years and older. So this is a very alarming number. That means it's a real thing. You're gonna live longer, most likely than your parents, than your grandparents. And are you prepared? So that is the thing. You can take a look at this. And this is me. I always imagine, when I'm older. I love this picture. It's just very happy life, but you need money to be happy. Okay, inflation. Let's talk about inflation. And I felt like this year, everybody really, really got a hit by inflation. And many retirees need increasing income because of inflation, because price is so much higher than because of the inflation rate, right? And this is the chart that I pulled from Google, and I just want to know the inflation. So the past years, the average inflation is about 2%, and the 2021 is actually 7%, the inflation rate. And we always hear the consumer price index, right? And CPI, the consumer price index, actually hitting 40 years high, and it rose 7%. And this 7% is actually the largest 12 months since June 1982. So we are seeing the inflation rate at its incredible surging without, we realize, right? We was comfortable here, and look at us now. And this is a very good statistic from AIG, one of the top insurance carrier. So they did some study comparing the 2000 to 2022, the buying power, your money, how much it is worth from year 2000 versus year 2022. So Social Security benefit actually took a 30% loss from the last 20 years. And prescription drugs, so these are all related to retirement, when you get older. Prescription drugs cost since 2000 has increased 252%. And the cost of goods and service purchased by retirees from the last 20 years has increased almost 100%. And your homeowner insurance is up 174% from the last 20 years. And real estate taxes is also 129%. So think about it. If you are retiring in 20 years, and your money, and a lot of time I ask when I do the client assessment analysis, I ask some client, how much money you think you will be comfortable when you retire? And they say, we will be comfortable how much money we're making now because we live comfortable life. And I think it's enough what we're making now for retirement. And I'm gonna tell you, no, it's not enough. What are you making now in 20 years? It's not gonna work the same because of inflation. So this is very alarming. So it's time really to think about retirement. And we also see the market volatility, especially year-end 2022. If anybody look at their 401k statement or your IRA statement, and you see it's red, you definitely took a loss. And whether the loss is single digit or double digit, I mean, I was at about 12% loss. And the market volatility is it happens most of the times every 10 years or so, but it happened this time, it's pretty quickly. And limited availability of traditional retirement income source, as I mentioned, so means great personal responsibility. I keep saying the words personal responsibility because I really want to emphasize it is really your responsibility to have a good retirement plan and to think your retirement strategy. Okay, and I'm going to pause for a bit and let you think about what are your retirement goals. How long do you want your retirement income to last? That's a very simple question, right? How long do you want your retirement income to last? Will it be nice to last forever? Yes. Do your current retirement plans provide guarantee? Does your 401k IRA provide any sorts of guarantee? Think about it. This doesn't apply to everybody, but it applies to a lot of people. Do you want to leave loved ones a death benefit? That's the third one. Okay, to think about this. And Pam and I actually do help many families. We have license like throughout many states, and we helped a lot of families do family financial planning, and especially retirement and college funding. When it comes to retirement planning, and these are the areas we really focus on, the number one is safety, because we want the money to be in the safe place, right? And the number two is growth. I mean, we can put the money in the bank, it's very safe, but it doesn't grow. So we want a growth. We want our money to grow, to have compound interest, to grow. And the third thing is longevity. Well, the money to help us to live a very, very long life. And that's something we need to think about it. What if in case we live too long, right? And the last but not the least, tax. Tax is a very serious thing in United States, in America. So tax, what is the tax benefit? Is that tax deferred or tax free? These are the things that we think about when it comes to retirement planning. And we found Annuity checked all these 4 boxes. It's a very, very good fit to have in your retirement portfolio, because it really maintain, it really give you like a good quality of life, right? This is me, I'm thinking, this is what I want to be when I'm 90 years old, to have afternoon tea with my bestie. And for couples, you want to enjoy your life, to live, a long life. So keep in mind, Annuity, it really, really brings those quality of your life during your retirement. And then the second most important thing is it gives you lifetime income. So I finished Y part, and I'm going to transfer to Pam to talk to you about everything you need to know about Annuity. Pam, go ahead.
Okay. Thank you, Lou. Thank you for explaining to us why a retirement strategy is important to our life. So I'm going to spend the next 20 minutes or so to talk about this option annuity. So what is annuity? Annuity is a contract between an individual and an insurance company. So the individual agrees to pay a premium to the carrier. The carrier, by accepting the premium, promise to pay a lifetime income to the individual. So through that contract, then annuity forms. It's an annuity contract, okay? So by the definition, annuity is paying a premium. The premium will be deposited to open an account, let it grow inside the account. So one day when we decided to retire, the insurance company will start paying us a lifetime income. So that is a basic structure of an annuity. So During the money growing inside the account, there are two phases. So it's called accumulation period. And how you receive the income, how much you're going to receive income, the variety of options for these two phases, 3 different annuities were born. So the first one being a fixed annuity. The second one will be fixed index annuity. The third one will be a variable annuity. Okay. So I'm going to briefly touch about fixed annuity and variable, but I will focus more today on fixed index annuity. Okay. So fixed annuity, by its definition, fixed annuity, it gives us a fixed interest rate, say 5%, 4%. That's guaranteed throughout the annuity. And there's also a promise, the insurance company will promise us a fixed amount of income, fixed amount of retirement income. So say $2,000 a month, and you'll get paid $2,000 a month as long as we live. But one thing I want to remind everyone, for fixed annuity, you only earn interest before you take your income. Once you start your income will not receive any interest. So that's the pros and cons about fixed annuity. It's very safe, very stable. You know exactly what you're going to get in terms of interest and in terms of income. It's very stable, but it's lacking growth potential. Okay, so that's fixed annuity. Index annuity, I will talk more later on, but there is one phrase I want you to remember if you can. Fixed index annuity provides upside potential and downside protection. So that's a phrase I will probably using multiple times throughout tonight. The last one will be the variable annuity. So looking at variable, that tells us nothing is guaranteed, everything changes. So the premium inside the variable annuity is invested in mutual funds and stocks. So your account value, your principal, your premium will fluctuate with the market, go up and down, go up and down. So it's very risky, okay, in terms of your investment goal. Retirement funds will try to avoid risky investment. So for variable annuity, most likely it's better for younger people because they have time once the market goes down, like what we experienced in the last year or so. It will take years. It will take some time for it to come back up. So for younger people, they do have the time to wait it out. But if you're in the late 50, 60, I don't think that's a good idea because we don't have that much time to wait for it to come up. So retirement income right now, we lose 20%, 30%. It's going to take another 10 years probably to come back up. That will greatly impact the amount of income that we will receive when we decided to retire. So when we talk about fixed index annuity, we will have several terminology that we will use throughout, but we're going to talk about the benefits about fixed index annuity. Remember, I talked about the phrase, you will have upside potential and downside protection. So the first one is your principal is always protected. You will never lose your principal. Accumulation is when your money inside deposit into the account before you take it out. It has potential to earn interest, but the interest is tied to the index performance. Okay, the money inside the annuity is growing tax-free before you take it out. We're going to talk about different sources of income or funds coming from outside to what kind of money you can use to invest in annuity, and that will trigger different tax consequences. Annuity also provides death benefit, and we can talk about that when we see the illustration as well. Some people may worry, if I put the deposit, put the premium inside the account, what if I passed away before I even take the money out? What would happen to my premium? Not to worry. If that's the case, annuity provides your death benefit, and that's available to your beneficiary. You're never going to lose your principal, and your income is guaranteed for your life. So again, the income with the opportunity to increase. So it matches what we just mentioned. You have upside potential and downside protection. So this sentence says every time you get a payment increase, when you start receiving the income, that new higher payment is always guaranteed for the rest of our life. Okay, so that's the benefits of fixed index annuity. Now, next, we're going to talk about what type of money that we can use to invest in annuity. There are two types of money we can use. One is called qualified money. Qualified money means the money is coming from a qualified plan. One being the 401k, traditional IRA. Those money you can move over to fund to invest in annuity, and those money stayed inside the annuity, growing tax deferred. You only get tax when you start your income. When you decided to retire, decided to take the income, that's when you pay the taxes. You can also use the money in your Roth IRA to invest in IRA. Roth IRA money, you pay tax already. So if once you move to the annuity, when you start taking the income, it's tax-free. The second type of money we can use is the cash, the money in your bank, in your brokerage account, the cash account. You can use that type of money to invest in annuity. Those investment principal has been paid. Cash is you already pay tax. That's after tax money. So once you take it out, the interest that you earn throughout the period is taxable. So you pay the tax when you take it out. So that's the two different sources of funds you can use to invest in annuity. So this, I covered it earlier. So annuity has two phases. Once you put the money in, put the premium in, it's growing inside, and it's called accumulation period. That's before you decide to take the money out. And then once you decided to retire, then insurance company is going to start paying your income. That's what we call income phase or distribution phase. Every company called a different name, but they all mean the same. Okay. So now we're going to look at the two phases and more details as in index annuity. So the concept is here. The first concept we wanted to remember is there are two phases. One is your accumulation period. That's when the money is in there. When after you open an account, it's earning interest year after year. So that's your accumulation phase. And once we decided to retire, here in the middle line right here, once you decide to retire, then your income will start. That's it, because that's going to call your income phase, or some people call it distribution phase. So you have two phases. Remember, that's the first concept we have, annuity. It has two phases. The second concept is there are two account balance that was calculated by the insurance company. Okay, the first account value is called cash value or contract value. It's all the same. This value is your principal, your premium, plus your interest that you earn throughout the accumulation period. That's your cash value. The cash value is used to calculate your death benefit and the withdrawal. The withdrawal here meaning that inside your accumulation period, if you decided that something happened, you have to surrender the policy, you have to take the money out, you have to walk away that money. There will be a surrender charge, okay? So this cash value is to calculate how much money you can withdraw, to take away, to walk away. So that value is calculated for that. And for the death benefit, we use cash value as well. So this one, the first value, account value, is cash value, is for withdrawal and for death benefits, okay? The second account value is called income value. The income value is used to calculate your retirement income. What is in the income value? It's your premium, your principal, plus the interest that you earn, plus your sign-in bonus, okay? So sometimes the annuity will offer a sign-in bonus, and like 35%, 32%, that's what we're seeing now in the market. So that sign-in bonus will be included in your income value. So if you decided to walk away, surrender your policy, that signing bonus will not be included. So that's the difference. And the insurance company keep track of these two different account value for different purposes. Okay, so that's the concept. Another concept, the third concept is, I have repeated that a couple times. It's upside potential and downside potential. Upside potential, downside protection. So when you have your premium inside the account, once you open it, it's going to earn the interest along the way. The interest is tied to the index performance. So for first year, if your index performance has a positive return, you're going to earn a positive interest. Your account will grow with a positive interest. What if that year you have a negative return? Okay, so the account will not lose the value. The account will stay the same and keep going forward until you go into the next year. If you have a loss, then your account value is going to go the same. You're not going to lose the value. Keep it the same. Say if you go to the year 2, end of year 2, you have a positive return, then your income or your account value will go up 3% as well. Okay, so that you continue to go forward until year 3. If you experience another negative return, the negative 4%, we're not going to lose our value. We're going to continue with the same level, moving forward to the next year. So for next year, year 4, we had a 3% positive increase again. Then when that happened, our income will increase by 3%. Okay, so then 3% new income, we receive that and we keep moving forward. Say at the end of year 5, we have another 2% positive return. Our income account will be increased by 2%. So by looking this chart, hopefully you understand this annuity. Why it is called upside potential is when we have a positive return, our income will grow as the positive return. If we have a negative return, we continue the same. So it's like climbing a ladder. You're always moving the same, keeping the same level, or you go up, you continue to go the same level, or you go up, depending on our performance, the index performance. Okay, so the money inside the annuity is invested in different index strategy. Different company offers different strategy, different indexes. We see most often you have Bloomberg index, PIMCO index, S&P 500, NASDAQ. So there are multiple different index you can choose from, depending on which product you pick. There are also credited method. You have 2-year, 1 year point to point, 2-year point to point, 5-year point to point. There are caps, there are participation rate, there's spreads. I will not talk too much about it for the time saving. We do have charges. You have to remember, for any annuity, there might be charges, there might be fees. You have to pay attention. What are they? So I mentioned about surrender charge. Some annuity products may have a 10-year surrender period. Some may have 7 years, some may have shorter terms. But pay attention to your annuity, the product you're choosing. How many years of a surrender charge would apply? So for this one, it has a 10-year surrender period. That means if you decided to surrender policy, you want to take the entire money out. If you take it out when you're in the contract year 1, there will be a 9% charges taken out from your principal. So that's the surrender charge. If you decide to take it out in year 6, there will be a 3.6% charges to your account. So be careful when you decide to walk away that money. So that would be surrender charge. When you do walk away, your signing bonus is not included in here. It's your premium plus your bonus plus your interest, you minus the surrender charge. The net will be your walk away money. Okay, so that's the charge. And another one is we want to think about the payout rate. How do we calculate the income when we decided to retire? Remember, we have a cash value, we have income value. So the income value is your premium plus your interest plus your signing bonus. At the end of the year, right before you decide to retire, that ending balance, that income ending balance, we take that number times the payout rate, depending on what year, what age that you're receiving your income. If I decided to take my income at 65, I want to retire 65. So you look at this line right here, between 60 and 69, if you decide to take a distribution, take an income, your payout rate is going to be 4%. So we take that 4% multiplied by your ending balance right before your retirement. That would decide your first retirement income, first year of retirement income, okay? So the payout rate is important. So the later you take your money out, the more percentage, the higher payout rate will be. Social Security, if you decide to take your Social Security at 62, there is a 70%, you can only take, not 100% of your entitled Social Security. There's a discount if you take it early. If you wait until 67, you get the full benefit, 100% of your Social Security. So this is the same concept. They encourage you to take it later, they'll pay more. The next table is also a payout rate, but it's from a different carrier. So they laid out the payout rate by age, not by range, okay? So this company, if you decide to take the distribution at 65, they actually pay you 4.85%. So it's a higher percentage. And you see if the longer you delay, the higher percentage will be. So that's the payout rate for different companies. Now we're going to look at the actual distribution, actual illustration. So we ran this company A with this product for a male age 50. The initial, the premium, the investment is 100,000. So when we look at the left table right here, you see the premium is 100,000. And then you will look at this column, it's called accumulation value. Remember, the accumulation value is the money inside growing. It does not include your signing bonus. So look at this, it's 100,000. And it will accumulate with your interest along the way. So that this one is your accumulation value. And the accumulation value is used to calculate your death benefit and your walkaway, your surrender value. It does not include your signing bonus. So that's the accumulation value. So the second value we talked about earlier is your income value, or we call pension value or benefit value. They're all different names, but they mean the same. Is your initial premium plus your signing bonus, which this case, this company offers 32% signing bonus. So you have 32,000 right away, plus the interest that you will earn in the plan. So the amount will grow over time, year after year. And if this person decided to retire at age 65, that means the money has been sitting in the plan, growing for 15 years. So age 65, he decided to retire, take an income out. We will take the value, the ending value as 64, which you can see from here. The balance has grown from 132,000 all the way to 1.264 million at 64. Then we will take that amount, multiply by our payout rate. For this company, the payout rate at 65 is 4%. So we take 4% times 1.246 million. Your first year income is $50,577. Okay, so from there, it's going to grow with the index strategies again. So you see that income, it's either stay the same or it's growing. Or stay the same, it's growing. The reason you see that every 2 years it changes number is because the index strategy that I use here is 2 years point to point. We will have more time. We'll cover more topic next time in our next seminar to talk about the strategies, the year point to point, the index selections, and all that. Cover more in detail. So hopefully you guys will come back and join us for our next annuity series. So the income you will see, you either stay the same or you have potential to grow. So that's the beauty of this index, fixed index annuity. Okay, you will continue to grow. Not like the fixed annuity, you grow when you're in accumulation period. Once you start receiving benefits, there's no more interest. So that's the fixed annuity. What we like about fixed index annuity, you continue to grow when you are in accumulation period, and when you are in the income period, you continue to grow interest. So that's what we call, again, upside potential. You always have potential to earn more throughout the life of annuity, and you have the downside protection. You never lose your principal, whatever you earn the year before. So that's the beauty of this product. Okay, so that's one company, and I want to show you another company with the same, almost the same feature. So this company, same thing, we ran it with the same scenario. Male, age 50, the premium is 100,000. In this company right now, they're offering 35% premium bonus, the signing bonus. Same thing, the person decided to retire at age 65. So we want to look at this red circle first. So the starting premium is 100,000, and it's called benefit base. The benefit base is the same as the income value, the income base, or the pension base, what we talk about compared with the last company. And the second circle here is accumulation value. Okay, so that's the account that's growing inside your accumulation value. It's the same as the cash value, the contract value. So this one doesn't include the signing bonus, and it's used to calculate the death benefit and your walkaway distribution, the walkaway surrender charge. Okay, so this 143,085 represent the first premium, initial premium, plus the interest, plus the bonus, and it will grow inside the plan throughout 15 years as well. You can see that it's growing every year. Why is it growing every year different than the other ones? It changes every 2 years because this one we ran it with 1 year point to point. So you see the interest credited every single year. So that tells you the difference. When you choose different strategy, you have different results. So this will show you a variety, a different option to choose your allocation strategy. So after 15 years, from 100,000 plus interest plus the signing bonus of 143, it grew to 700, almost 700. So 700,000. We'll take this ending value, okay, multiply by their payout rate. Then we come up with this your first initial income amount, so 34,213. I want to point out here, sometimes people think, if you look at the face value, you think that 35% signing bonus is bigger than 32% signing bonus. So this policy must be a better one. So by looking at the illustration, it tells us may not be the same, may not be the case always. So you want to have someone, professional, licensed professional, run you through the illustration, compare different products. But don't look at the face value. You think 35% is always better than 32, not necessary. You think the payout rate is better, and not necessarily generate a better result for you. So this illustration will tell you. However, this policy, if you continue to grow, it gives you a lot more potential when you go past certain age. So there's a multiple area you have to look at the policy to decide which one really works for you, which one is the best for you. So you have to compare policy, look at different features, make comparisons, then you can decide which one actually works for you. Okay, so there's no one size fits all. You have to look at different ones and compare. The next one is a very unique example. I want to show it to you because we talk about death benefits in annuity. People will worry that once we put the money in, before we take it out, what happened if I pass away? So the money inside will become death benefit to your beneficiary. But when we talk about death benefit, the best tool, the most effective tool would be a life insurance instead of an annuity. But the life insurance needs underwriting. It needs medical exam, and not everyone can be qualified for life insurance. So for someone that, you cannot pass your medical exam, you cannot buy a life insurance, you're not qualified for life insurance, but you do want to leave a legacy for your children, for your family, what would you do? Annuity will be another option for people like that. If you don't have the qualification to buy life insurance, you can buy an annuity. So this example shows someone at 65, they put in 100,000 in there, but their goal is not for retirement income, it's not for the lifetime retirement income. So they can buy this policy, leave it there, and they don't take any income. You can look at the death benefit, how it grows, okay? So a person put in 100,000, let it grow inside annuity. If one day this person passed away at age 80, for example, we look across age 80, the death benefit that's be available for this person's family or children is $527,980. So, but by leveraging 100,000, if the person passed away at 80, the death benefit will be $527,980. So that's another way for those people not qualified for life insurance. This is a way they can use annuity to provide death benefit for their family. So annuity has multiple features depending on what your goals are. What are you looking for to an annuity? If you're looking for short term, you want to just put it there for a few years, you want to walk away, take out. Fixed annuity might be a choice for you. Fixed annuity has short-term ones, not always the lifetime income. But if you're looking for lifetime income, as long as we live, the company continues to pay, then you probably want to look at fixed index annuity. Okay. But if you're young, you're more risk tolerant, you don't mind, putting your money in a risky market, you may consider variable annuity. It's a good option for you. So there are many different features, many different types of annuity you can choose from. You have to make sure you know what you're looking for and find the one that suits you. Okay, so there's no one size fits all. And that will conclude my presentation here. So Lou, would you like to take over from here? Lou, you're muted.
Sorry, I'm back. Thank you, Pam.
Yeah.
I actually gonna go back to this slide just a little bit. Before I finish this, I just want to point out, because this is a this is a insurance product, sort of like you're contracting with an insurance company. So the death benefit, the biggest difference with the death benefit is it doesn't have to go through the probate, right? And it's treated like a death benefit. So there is a difference, like if you would have this money in the bank, it's very different. And then also for death benefit here, I think annuity, like the two product that we choose, actually, instead of walking away with the account value, that's one option. The other option, if you still have cash value left in your account and you unfortunately pass away, and your beneficiary can choose to get the death benefit in multiple years, and that will come out from your income value. So not one lump sum death benefit, but instead maybe 5 years or certain years, and then you get bigger value. So that's one thing that I thought would be kind of interesting to point out. Anyway, thank you so much, Pam. And I hope everybody learned a lot. And I hope it's not too technical because Pam is very good at product details and she is so excellent, amazing with product details. And but it's something that you really want to know. And I have often clients, I mean, I have different kind of clients. I have clients say, I don't know anything about annuity, tell me about it. And I have clients that, you know what, Lou, do you sell annuity? Pam, remember my client text me, do you sell annuity? I say, yes, I do. Can I buy this and this annuity because there is a bonus I heard from the radio? I said, of course, but can I talk to you first, right? Because as a professional financial professional licensed, and we are very responsible for clients' needs. And I felt like it's important to know, even though the bonus might sound incredibly attractive, but we need to know the product in and out and always find out what's the best fit for the customer, for the clients, right? And that's why I always do talk to them and I find out what their goal. And to be honest with everybody, annuity is really the best when you do lifetime income. And annuity is at its best if you can live long time. So, and it's a very good incentive when you buy an annuity because you got to constantly remind yourself, I got to live a better life. I got to live longer so I can get all my money back and times 2, times 3, times 4. That's the bottom line. You know, you have an incentive to live longer. Anyway, we offer a lot of product with many reputable financial carriers. And we only list few because these are our favorites. And these are top rated. And we only sell top rated rating financial companies because with a long-standing history and a very good financial books, you know, we like those. And the product that we illustrated, one is Allianz, which is if it's not number 1, it's number 2. And then the other one is Athene. If it's not number 1, it's number 2. So they're constantly competing the top annuity sales company in the United States. And they are the top 2 at Allianz and Athene. And so we thought it's good to illustrate those companies for you and to let you know the product feature a little bit. And once again, there is no best product and it's only the product that fits your needs are the better ones, right? A lot of time clients, you know, if you ask your client, do you have a financial advisor? And oftentimes you hear them say, yes, I do. I have my financial advisor. And the financial advisors that they have and they think is the one that managing their investment portfolio. And that is only part of the financial planning. And we want to emphasize on that. And investment risk management, your investment account, your stock, your mutual fund account, and those are part of the financial planning. But Pam and I are more passionate about all around financial planning. So retirement is our first topic because it's just so timely because this insurance company currently, they're offering this 32% bonus that's only for limited time until April 3rd. So we thought we wanted to bring this best, you know, most talked about product discussion, and we want to let you know a little bit more about this product. So retirement planning, and then college funding is also another area that we cover a lot. Tax optimization, who doesn't want to save money on tax? We're paying way too much tax, right? And also protection and the long-term care, and is something that me and Pam are very passionate about, long-term care. And last but not least, you know, when you get everything done and there is an estate planning for your family. So we are working with a estate lawyer, and we're going to bring maybe like in April sometime a talk and a discussion about the importance of trust, will, and estate planning. And you probably don't want to miss that. And the best way to get annuity assessment in your retirement portfolio is actually just, make an appointment with either me or Pam, and we work together, design the best product for our clients. So we do provide a free 45 minutes consultation. And during the consultation, we will ask your goal and we will assess your risk tolerance level, because we want to know what is, some people, I have a client happy to buy a fixed annuity, simple interest, and totally happy. And I have client that's not young, but want a variable. So there is different type of clients. You cannot, just know by age or anything. So we want to have a personal consultation just to get to know you and to help you. And retirement is quite an urgent, matter, especially if you are like my age, like a 50s, right? And this is the time that's quite a critical, that you want to make decisions, to make good decisions. So that concludes. Pam, do you have anything to add?
One thing about, if you talk about taxation, you have to remember what type of money that you goes in to buy your annuity. So when you take it out, the tax consequences are different. Death benefits the same. So if you have the pre-tax money going in to buy your annuity, so if if we do pass away early, that balance pass on to your beneficiary, that is a taxable death benefit to your beneficiary. But if it's a Roth IRA money going to annuity, when that becomes a death benefit, that'll be tax-free. So watch out for the tax differences when you take out the death benefit from the annuity. Again, like Lou mentioned earlier, you can choose, the beneficiary can choose to take the death benefit in several years, in 5 years or more. Then your tax consequences, your tax amount will be less. If you decided to take one lump sum death benefit, then you'll be taxed in that 1 year, depending on what type of money go in the beginning. So that's something, when we talk about death benefit, I just want to point out that here for everyone.
Very good. Thank you. So we do have a question, and I'm going to ask Pam to answer that. Is there any minimal age to buy annuity from Alvin?
That depends on the carriers. So for Allianz, the minimum age was